The greatest untold truth about compounding tables is that an investor will experience drawdown. Most texts only focus on capital appreciation, as though the market never retraces. Nothing much is mentioned about limiting losses. Hi guys, this is Hazel from the Joyful Investors. This is one common slide that you see when trainers want to inculcate into you the importance of starting early in an investment journey. There is nothing wrong with starting early, but it is very wrong to think that things will only go up from the moment we get started on investing. If there are huge drawdowns in the earlier years especially, the resultant figure would be a lot different, and that is because the compounding effects of losses are now working against you over time. For any retail investor who have met with setbacks in the second or third year will know what I mean over here. If your portfolio declines in value by 50%, you will need to gain 100% to get back to where you started. Part of doing well in the stock market is knowing when to be on the offense and when to be on the defense. Financial advisors will have you 100% invested most of the time, for reasons that you would know of. Such behaviors are incentivized by the commissions of the sales representatives, and better still, to top up further with dollar cost averaging techniques. On the other hand, we have the hedge fund managers who may not be able to hold too much cash as they are obligated to stay invested most of the time. But as individuals, we can. That is also an advantage that we can have over them. The mainstream media always tell you not to time the market and says what happens to your portfolio performance if you miss the top performing 10 days, but they don't show you what if you avoided the top 10 days of biggest losses. While we can't predict exactly, we can attempt to avoid or mitigate our losses by adjusting our cash positions based on probabilities. We may not be able to avoid all of them, but even if we manage to avoid just half of them, that will still go a long way. So what do other books or financial bloggers say about how to protect our portfolio during the bad times in the market? Some of them will suggest that you learn how to short the market. This is the worst ever thing that an investor should do. Or rather, most people not know about this. The losses can theoretically be infinite when you go short in the market because there's no limit to how high something can go. You may make some money in the short run when the market has a pullback, but if the market continues to go up, your losses can be hefty. This is the easiest way to bust your account, and that is because for every $1 that the share price goes up by, you lose $1. So the risk to reward is not working in your favor. The financially savvy way would be to employ put options, which will give you a way better risk to reward ratio when you have a directional bias that the stock may be trending down and that you would like to have some protection. A buyer of a put option gives you the right to sell an underlying at a determined price on or before an agreed date. Your maximum losses are also limited when you buy a put option, no matter what happens. When it comes to losses, we want to be certain, and you can't do that if you just simply short a stock. The key is in knowing to buy at what strike price and when to do it. That way, you'll be able to enjoy some good downside protection for your portfolio, which only costs a small fraction of your portfolio. In the event that the stock price does not come down, you'll still be better off even after you less off that insurance premium you paid for. This is one of the option strategies that we employ in our Moneyball playbook that allows us to take advantages of opportunities even when we are on a downtrend. So for those who are untrained in options, just know that such a tool exists for you to learn to properly use it instead of shorting the market outrightly. If this seems to be too complicated for you, then you can consider holding some cash as a way to hedge against market declines. As an investor, always worry about risk. Worry about the downside uncertainty. Once you do that, the upside will eventually take care of itself. Amateurs often think in their mind, how much can I potentially make from this trade? Professionals, on the other hand, will always ask themselves, how much can I potentially lose from this? By having such a mindset, this will improve our portfolio performance drastically. Two such metrics that we could use to judge how much returns we achieve per unit of downside risk is the Sortino ratio, which can be retrieved in the report of some of the brokers. The other is beta, which measures the correlation with the benchmark. Making excessive returns without knowing the context of how much risk a person takes is not meaningful. Outperformance due to high beta of one's portfolio will also mean that it is going to be highly underperformed when the market turns up. The ideal investor should have both preservation and appreciation in mind, but at any given time, one will be more important than the other. Most people who manage their own money, or worse still, manage other people's money, only put either one as the constant top priority. It is alright to have some bias, but there are times when we should focus more on one over the other. And in this context, I'm referring more to the people such as millennials and Gen Z who have a longer runway. For retirees, it's perfectly fine to solely focus on capital preservation. It is very important to pursue capital preservation when times are tough for the market, because taking the risk for capital growth may likely result in capital shrinkage. In such a situation, your goal should be to avoid taking losses, so that when the market improves, you have more capital to work with for capital appreciation. In short, this is what a lot of people miss out. Risk doesn't just come from what you buy, but also when you buy it. Most people assume that risks are mitigated so long they buy a basket of diversified stocks and hold it all the way. And this makes it easy for wealth advisors to justify what they are doing without much ongoing effort. Mainstream media always tells us to stay invested fully and don't time the market. It is true that many people and even more hedge fund managers can't beat the market. But it is also true that a small handful of people are able to reasonably, consistently do so as they know what they are doing. You are what you choose to believe. Read about market wizards during your free time, and they are living proof that it is possible if you take the time to learn how to do it properly. Our portfolio is also living proof with high transparency in what we do, such as topping out our account by being more aggressive or having more cash at the sidelines when it's time to be defensive and to trim some of our positions. While we may not be able to get it right all the time, if we manage to get it right just half the time, we will still be better off. Risk management of your portfolio is something which no one will be more interested in than yourself, because no one is sufficiently compensated to do so for you. That is why we must take the responsibility and learn how to grow our portfolio using the right tools at sustainable returns. Thank you for watching this video. We hope it has been an insightful one for you.